Well, Treasurer Jim Chalmers spoke to his American counterpart Scott Bessent this morning and used the call to lobby him over the Section 899 tax proposal, which forms part of Donald Trump's big, beautiful bill. Now, if the bill passes, it could result in Australia being deemed a discriminatory foreign country, which could result in Aussie businesses investing in America being charged higher taxes. Here's the Treasurer speaking at a press conference earlier.
I know that there's a lot of concern amongst our Australian institutional investors, super funds, the Future Fund and other institutions when it comes to Section 899 of the proposed so-called Big Beautiful Bill in the US. I've engaged a lot with Australian investors over the course of the last couple of weeks on their concerns. I was able to represent them and raise their concerns directly with US Treasury Secretary Bessent. And I know that the Treasury Secretary is very focused on these issues as well. We hope that they can be resolved. We do not want to see our investors and our funds unfairly treated or disadvantaged when it comes to developments out of the US Congress.
Well, for more on this and a recap of the inflation numbers, I'm joined by My Bui from AMP. Look, thanks so much for your time. The Section 899 proposal, clearly Aussie businesses and investors are pretty concerned about it. I mean, what do you make of the tax proposal here in America?
Hi, Ed. I'm definitely quite concerned about Section 899. This is part of the One Big Beautiful Act bill in the U.S. is actually right now being reviewed in the U.S. Senate and is expected to pass the Senate sometime this summer in July or August. This is basically a form of revenge tax against foreign countries that impose unfair foreign taxes against U.S. companies. And it can be quite arbitrary. For example, if the U.S. Treasury Secretary doesn't like our GST, they can deem us having unfair trade practices against the U.S. and impose this tax upon Aussie investors. It basically is expected to raise taxes on U.S. assets, U.S. incomes for Aussie investors of up to 15 to 20% over the coming years. And I think the concerning thing about this Section 899 is that since the definition of unfair foreign taxes is quite arbitrary, it is quite hard to get it out of the Section 899. For example, it is very unlikely that Australia will get rid of our GST. The second concerning thing about this tax is that most of our super funds are quite heavily invested into U.S. equities. So U.S. equities account for 60 to 70% of global developed markets equity. That's quite a sizable amount. So right now, with the environment that the U.S. has pretty flip-flopped on their trade practices, this tax will basically make U.S. assets much less attractive to Aussie investors, and most of them are just normal superannuation fund holders.
Yes, so do you think if this bill does come into effect, big Aussie super funds could start withdrawing capital from the United States and placing it elsewhere?
That is definitely a concern. I think we are definitely at an inflection point of a regime change when the U.S. starts to look a bit more inwards rather than outwards, evident by their trade practices, for example, putting up tariffs. So this has prompted investors to rethink about putting more capital into the U.S. Maybe it is a more attractive time to actually put money into Aussie infrastructure or European equities. Both of those have basically outperformed U.S. equities since the beginning of the year. Of course, there is still rationale for putting money into the U.S. For example, they still have very good corporate profits growth. They still have very good productivity growth, especially in the tech sector. But certainly, these trade practices as well as Section 899 taxes will make it much less attractive and probably will make super funds in Australia rethink about deploying capital in the future.
All right, let's turn to the inflation numbers today. Came in a bit better than the market was anticipating. The market seems to be locking in an interest rate cut next month. Is that your reading into it as well?
Yeah, I think the inflation numbers are definitely on the other side. It's definitely a positive news for us, unlike the tax news. So we've had trimmed mean inflation, which is the number that the RBA cares the most about, at 2.4%. That's on the lower end of their target band. And please note that the trimmed mean inflation indicator has been in the target band for about 6 months now. That's also not to mention the headline inflation indicator within the target band for 9 months, 9 consecutive months in a row. So that's very, very good news for the RBA. RBA. So if I were the RBA right now, I would probably look at the facts that we've had rather tepid GDP growth of just 1.3% over the last quarter. We've had negative GDP per capita growth for 9 out of the last 11 quarters. And now we've had inflation firmly within the target bands for quite some time now. So this is basically a call for the RBA to look at these domestic developments and continue their cutting cycles. A lot of our peers abroad, for example, the ECB, the BOE, for example, they've had even higher core inflation numbers for us, and they have cut for more than 50 basis points. The RBA has only cut twice by 50 basis points, and I think it is about time that the RBA needs to bring rates into a more neutral level rather than the restrictive level that it is at right now.
Yeah, it's also worth noting these monthly numbers are a bit volatile, but they clearly are they do look pretty good. I mean, how many more rate cuts do you think we could see by the end of this year?
I mean, I do agree with you that the numbers are quite volatile, but the fact that it has been entrenched in the target band for quite some time now is a very encouraging sign for us. And I think today's number poised to downward pressures for a full trimmed mean quarterly number, which the RBA will certainly care about. For the second quarter, we probably will see trimmed mean number around 2.5, 2.6%, because that's a very good number. We do expect the RBA to cut probably 4 more times, which is roughly the market expectations as well. We see rate cuts in July, August, November, and probably February next year. That will take cash rate to just 2.85% for this cycle.
My Bui, thanks so much for coming on the show. Appreciate it.
Thank you.